Hi everyone, this is Jason Barack of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a returning guest. It's oil and energy expert Robert Rapier. Thanks for coming back, Robert.
Thanks for having me again, Jason.
Now, Robert, you've put out some two very interesting pieces recently. I want to go in depth on both because I think Wall Street is just not really paying any attention to the fundamentals of the market, or they're looking at the things wrong. You put out two interesting pieces, like I said. One of them is on oil inventories, and the Wall Street seems to be missing, getting the wrong read on the oil inventories. And the other one is we won't see $30 a barrel oil. So let's start with the oil inventories one first.
Yeah, that got a lot of momentum over the past couple of months that we were going to run completely out of crude inventories. And that's part of that's a little bit of a misread of the inventory situation. It's true that inventories are very high historically, but we've still got a lot of room left. And at the rate we've been adding over the past year, we could actually add to inventories for 4 more years before we're full. Now, in recent months, that has accelerated a lot. We've got a lot more oil going into inventory than we've had. So the average over the past 3-4 months is high enough to fill inventories up probably within a year. But one of the things that I pointed out is this is the lowest demand season, and refineries go offline in March, April, and then they start to come back on. And the difference in demand right now and the middle of July is probably going to be about 10 million barrels a week. And that's what we've been building inventories, about 7 to 10 million barrels every week. And what I've been saying is the situation will level off and refiners will start to pull that down. And a very interesting thing happened this week. In fact, the refiners are coming back online, and the U.S., 2 weeks ago, the U.S. production dropped for the first time this year, or the first time since January anyway. And then this past week it was nearly flat. But the refiners have increased a lot over the last 2 weeks. They've come back online. And it is enough that it should have brought inventories down. If you're only looking at those numbers, you're looking at demand by refiners and you're looking at U.S. production, inventories should have come down. But instead, we got a 10 million barrel build this week, which was very strange. So I went in and looked, and what happened is our imports surged. Now, I'm not sure why that happened. I haven't worked this out yet because we're sitting on a lot of inventories. It's true that the refineries in the U.S. are not geared to handle that light sweet oil, but I don't think they're saturated yet. So it's a little puzzle to me why we had such a surge in imports when our inventories are sitting at high levels. So I've got to work that one out.
Yeah, if we're importing all this oil, I mean, it disproves this myth that the U.S. is going to be completely energy independent from just shale oil production, right?
Yeah, people don't. I think they don't realize that we are still a very large net importer of crude oil. I think we're behind China now for net crude oil imports. We have over the past few years started exporting some finished products. So refiners that could handle the light sweet crude, they are refining it, and then they're sending. We don't use as much diesel as a lot of countries, so we're shipping out a lot of diesel and a little bit of gasoline. And since there's a crude oil export ban in place, the refiners are making pretty good money sitting in that spot of buying the discounted U.S. crude and then being able to sell the products at international prices that are more set by Brent crude.
Yeah, if we had a free market, Robert, and the U.S. oil companies were able to build more refineries for that light sweet Bakken crude, we would have a lot better supply-demand balance, but, it's very difficult to build a pretty large refinery. I think building a 50,000 barrel per day refinery, the EPA just won't allow it. I think there was a smaller refinery that was allowed to be built in the Bakken in the last couple of years, but other than that, there really hasn't been a brand new refinery built in decades, right?
Right, not in the U.S. I mean, in other countries, they certainly are. They have figured out, countries like Saudi Arabia thought, we're shipping out our oil and we could be converting it into finished products and getting a better price for it. I think if we had a totally free market, what would happen is we would start exporting a lot of this light sweet crude, and then we'd start importing more heavy oil. So the net import situation would be the same. We'd still be a very high net importer of crude oil. It's just that the slate would shift. So we're bringing in more heavy, and the light that we have are going to places like Mexico, which they're working out a swap right now where they send us some heavy oil and we send them some light oil.
Yeah, that's interesting. Now, your next article, and I think this is an important one. We're just hearing all these bearish arguments. You know, Dennis Gartman's coming out. I think that the Manhattan Institute is, I guess, it's a research analyst firm in Manhattan on Wall Street. They put out a Forbes article. You and I were discussing this off air, you know, a couple weeks ago, and I think they said that the oil price will never go above $50 again because of shale oil. You wrote this counter article debunking a lot of these negative bearish articles. They just seem to be extrapolating the trend in the oil price, but I think many of them didn't even see the oil price even falling.
Right, and I'll point out that we are back above $50 right now. You know, one of my predictions for this year was we will not drop below $40, or we will not close below $40. And I wrote an article for the Wall Street Journal, and I said, here's why those arguments of $30 oil are very unlikely. And I went through the scenario. I mean, ultimately, oil can get out of whack with supply and demand fundamentals for a while. I mean, it's happened lots of times. And 2008 is a perfect example. We went to almost 150 down to the 30s in about 6 months. And the supply-demand fundamentals didn't change so that drastically over that time period. It's just that we overshot on both directions. But eventually, you have to come back to the supply-demand fundamentals. And the supply-demand fundamentals say we really need oil above $50 if we're going to continue to supply the growing demand around the world. And demand is still growing, and it's still forecast to grow. The growth in demand may be slowing a little bit, but with oil prices down, it's actually, you know, it'll probably be picking back up in some of these areas that have seen a bit of a slowdown. So I made the argument we will not see, if oil drops below $40, it won't be for long. And, you know, I got some pushback from, you know, there's an analyst, Philip Verlanger. He commented on my Wall Street Journal article, and he was like, no, all these guys got it right. Ed Morse was correct, and Dennis Gartman has been right, and none of the Wall Street Journal experts got it correct. I don't know if you know who Verlager is, but I answered him. I said, I was right. I predicted last year oil prices would fall, and they did fall. And right now, my prediction in this article is we won't see, I mean, I predicted we won't see 40, but the article was arguing why we wouldn't see 30. And his argument was just, he says the author misses an important point. Producers can hedge production at $60 or $70. What difference does that make? That doesn't affect whether we'll see $30 oil. I think he mistook my argument that I'm saying we're going to go back to 100 soon, and I don't make that argument. I think we're going to be in the 50 to 70 range for a bit, but when we break out, we generally break out to the upside. So I think we'll see similar to what we saw in 2008. We overshot to the downside, we came back up, and then eventually in 2008 we were back above 100 within 15 months after we collapsed. I don't think we'll see it that quickly, but oil prices will creep back up over the next few years.
Yeah, I think the oil prices are going to have to creep back up. I mean, we're consuming, how many barrels of oil are we consuming a year? Over 3 billion barrels, right, that need to be replaced eventually, right?
Yeah, something like that.
Yeah, and the IEA, the International Energy Agency, for listeners who don't know the abbreviation, the acronym, they're predicting actually that the oil demand is going to increase by the end of 2015 from, I think, 92 million barrels per day, approximately what it is now, to 94.5, because they expect this lower oil price is going to stimulate more demand. So we're starting to see that in the marketplace, at least here in the United States, where more people are starting to, buy or lease SUVs again. They're starting to consume more gasoline. And we're still seeing, I think, the car sales in China, they're still enormous. They're just the car sales in China, they're putting over 10 million new cars per year into the total global fleet.
Right, and that's I've seen several articles from car dealers saying that their SUV sales and their big vehicle sales had come up since gas prices were down. The Energy Information Administration showed that over the past few years, demand in the U.S. has declined, but over the past year, it's picked back up. And, that's always the case. When oil prices are low, people forget about, how high they can get, and they say, okay, well, I'll make a decision on what vehicle to buy based on where gasoline prices are right now. I can afford to drive this vehicle with gas, where it is now. And so it always happens that those big vehicle sales tick up, and that will affect the markets for years to come. And it has. If you just compare demand today to demand a year ago, we are around 500,000 barrels a day higher demand than we were 12 months ago.
Yeah, I think the supply glut, I think most of the estimates I've read, Robert, that this supply glut, and I'll use that in quotes, is about 1.5 million barrels per day at most globally. And, when you compare that to total global oil production or total global demand, it's not a huge number. It's only about 2%. So this is not, a 5, 8, 10% supply glut here where the market is massively oversupplied. That supply glut could come offline very quickly, especially here when you have all these shale oil producers that the only reason a lot of these guys are in business is they took on a lot of debt and they hedged their oil production. Those hedges, you look at a lot of these oil producers and they were able to hedge, 6, 12, 18 months out a while ago at $90, $92 a barrel. Those hedges are going to come off, right, in the next 6 to 12 months.
Yeah, that's correct. And I know some guys who miscalculated. Harold Hamm miscalculated because he thought around $70 that oil prices weren't going to go any lower, and so he cashed in his hedges, and that has cost him some money already. If you look at where the oil production around the world has come over the last 5 years, and demand, you talk about there being a 1.5 million barrel supply buffer. That's probably true. Our demand over the past 5 years has increased every year by an average of about 1 million barrels. So it wouldn't take long. And then when you look at where the new supply has come from over the last 5 years, it's been mostly shale oil. And as producers cut their capital budgets a lot, you're going to see that growth stall out. We're already seeing it. We're seeing the growth. Like I said, the last couple of weeks have been flat. 2 weeks ago, we actually declined. And you're going to see this growing demand, this 1 million barrels a day, run head on into supply starting to pull back a little bit. And there you're going to get the oil prices to go back up. I don't believe it's feasible. And I've argued again and again, I don't think it's feasible that oil can be at $30. Only from an emotional standpoint, I think, can oil be at $30 because the marginal barrel costs a lot more than $30 to produce.
Yeah, I completely agree. Maybe for another a little, if oil would have had a spike low, maybe and touched 30 for a couple weeks or a month or maybe 6 weeks or something, that would have been the market could have maybe withstood that. But then you would have seen actions from market participants like in 2008 when the oil crashed after it touched 150 with that remarkable volatility, where Russia and Brazil were desperate because they knew they couldn't make any money at the current market price in 2008 and 2009, and they had to sell it above the spot price. And then the Chinese would just come and swoop in, with long-term contracts at way above the spot. I think we've seen China lock up a humongous amount of tankers, right, in the last 6 to 8 months, just buying up as much oil as they can and shipping it over there and building up their strategic petroleum reserves at these cheap prices.
Right. Exactly.
Now, my next question is about the rig count. Normally in the past in oil markets, the rig count was, I guess, a leading indicator for the oil price. So if the rig count was falling rapidly, and we've had the rig count, I think, fall approximately 50% since June of 2014, but the oil price hasn't responded to this necessarily yet. Why, in your opinion, hasn't the rig count falling so drastically, especially onshore, for U.S. shale producers affected the price yet?
Yeah, it'll take a little bit for that to substantially impact production. The oil that's producing now, those wells have been drilled and that they're producing. So the rigs that would be out there right now, that's going to impact supply a year, 2 years from now. So we'll see those supplies missing because of the rig count. If you look back at what happened to natural gas rig counts back in maybe 2010 or 11, the natural gas rig count plummeted, but natural gas production continued to go up. And that's because they were learning, they were getting up that shale gas learning curve. They were able to get more production out of single wells, and they were able to drill multiple wells out of one pad. And there were lots of different things that they learned to do. So even though the rig count collapsed in natural gas, and most of it went over to oil, natural gas prices didn't come up much. They stayed pretty low. And so, had the natural gas rig count stayed up, we might see substantially higher natural gas production than we do now, and even lower prices than today's low prices.
Yeah, that natural gas, a lot of it is being produced as a byproduct now, right? Because the natural gas rigs have fallen so much, but the natural gas price hasn't responded. I think you expected higher natural gas prices a while ago, but because there was so much shale oil drilling, a lot of natural gas was being produced as a byproduct. But eventually, though, because these shale wells deplete so rapidly, the rig count falling, even though there is some, I guess, productivity improvements with new technologies like multi-stage fracking and things like that, and they can get, I guess, a higher initial flow rate from the wells, this is going to catch up to itself, right, eventually at some point when the rig count falls.
Yeah, and on natural gas price, you mentioned something. Last year I predicted higher natural gas prices in 2014, and that was because we had depleted so much during the winter, and I predicted that our average natural gas price in 2014 would be higher than 2013, and it in fact was. This year I predicted we're going to be substantially lower because we were able to refill those inventories so rapidly over the summer that when the winter started out a little bit mild, I said we are in danger of hitting very low numbers on natural gas. And so that was my prediction for this year. I expect low natural gas prices. And, we could see, last time we saw below $2 was in 2012. We could see that again this year. We could, by summer, natural gas prices could drop down. So, if you're investing in natural gas, you need to be doing it for the long term because you're going to have to be a little patient on this one.
Yeah, I don't think the natural gas producers, Robert, are that good at investments yet. I think the natural gas pipeline companies maybe, or some of the LNGs, or some of the LNG export facilities. I think Cheniere is pretty close to bringing their export facility online. I know others got approved and they're spinning them off into MLPs. If they have long-term offtake agreements where they can export that liquefied natural gas to Europe or to Asia at a much higher price on a long-term contract, I think those are interesting yield plays there. But investing in maybe Chesapeake Energy or I forgot the other primary natural gas producer.
Cabot is one up there. Yeah. Devon is a major natural gas producer, but they're shifting more production over into oil.
Devon was the one I was thinking of, yeah.
Well, Cheniere is interesting because somebody asked me just a couple of days ago if I thought, he named two investments. He said, I'm in Cheniere and I'm in Enbridge Energy Partners, and which one, do you think these are good investments? I said, understand those are very, very different kinds of investments. Cheniere is very much more speculative. A lot of Cheniere's growth in share price has been, it's built in. The expectations that LNG facility is going to come online this year, that's built in. And even though it continues to go up, that one at this price would scare me a little bit because I think there's significant downside. If there are any stumbles at all, I'd be worried that you could get a pretty sharp correction on that one.
Yeah, I agree. There's also a MLP place for companies that are going to move the gas from Cheniere. So Cheniere is going to convert the CNG, compressed natural gas, in the pipeline to LNG, and then the tankers are going to move it. So I think there's tanker plays attached to that. But yeah, you're right. These large high capex projects, there's always very rarely do they come on on time and on budget. There's normally always delays, especially what I've learned because I've invested in mining companies. And when they have an initial budget plan, though, the mine's going to come online next year at this price, there's almost always delays and almost always capital overruns. So I expect, I guess, that there's going to be something along those lines.
Yeah.
Now, my next question is about production costs for the Eagle Ford and the Bakken. We've had some amazing. If our listeners go out and read books, great books about the fracking, there's some documentaries, but the books are The Frackers, and then there's also The Boom. I just read that too. There's been amazing, multi-stage fracking, and we've gotten more efficient with being able to get higher flow rates on the wells and going deeper. And there's different levels of the shale. Have production costs fallen a lot for the shale producers yet, or have they not really fallen that much?
No, they've fallen quite a bit. I mean, anything, fracking is not new and horizontal drilling is not new, but the combination of the two together is fairly new. And as you go up the learning curve, you do learn how to do, multi-stage wells and lots of different things that will drive prices down. And so probably 5 years ago, marginal cost may have been up in the $80, $90 range. Today, it's probably more like $50, $60. I've seen some people claim lower than that, down to 40, and I saw maybe it was a Wood Mackenzie report that said that at $50, only 2% of the oil producers were going to be losing money. I don't think that's correct. You wouldn't see the drastic level of capital spending cuts if that was true. If they still were going to be making pretty good money at $50, I think you wouldn't see huge slashes in the capital budget. So I think $50, $60 is probably a good number for marginal cost. But you have some plays that are significantly more expensive, and you have some. The Eagle Ford is generally known to be the cheapest out there. Maybe the Permian is close, but a lot of the Permian is conventional production, and it's been around forever. I mean, it's one of the longest-lived oil fields in the U.S. And the Bakken is a little more expensive, and so you're seeing producers in the Bakken collapse into a small core up there of the sweetest spots. And I think you're going to have to see oil prices rise back up $70, $80 before you see some of those companies getting back out and drilling in some of the fringe areas.
Yeah, a month or two ago, I was listening to an interview with a Sprott portfolio manager. They're up in Canada, and he was quoting an investment bank report. I forget which investment bank, but the report said that only it actually said the exact opposite of the research report you just quoted. It said outside of the national oil companies, only 3% of the global oil production, so the private sector's oil production, only 3% of that was economic at the oil prices we were at. So it was like, how sustainable is this?
Yeah.
My question, though, and you touched on this a little bit about the production costs, what happens, though, when the hedges come off? A lot of these shale oil producers use a lot of debt to drill. Now, they didn't hit dry holes, so they knew the oil was there, and they did a good job getting the oil out. But their costs, I think they have so much debt on their balance sheets where their costs have not fallen and they're not generating free cash flow to pay off the debt. So what do you think is going to happen when those hedges come off? Are we going to see bankruptcies? Are we going to see, the investment banks force, like with Whiting Petroleum right now, where they had an emergency capital raise with debt and equity? Are we going to see the investment banks or shareholders or the board of directors force fire sales or bankruptcies?
You're going to see all of that. As the hedges come off, it's going to cost more to hedge. So they're going to decide either, okay, we won't hedge, we will sell our oil at the current price, or we'll pay a significant premium to hedge. I think most of them are going to try to keep their heads above water in the hopes that oil prices return back to $70 or more. And, they're going to do those emergency capital raises. You're going to see some bankruptcies. I mean, we've seen a few already. You may see some bigger ones. You may see more acquisitions like Shale buying BG Group. One of my predictions this year was that BP would get taken over. I don't know if that'll happen this year, but, BP is very undervalued, but they've got all that litigation still hanging around them, and they've got a damaged brand name. So it wouldn't surprise me at all. And it's been speculated several times that Shell might buy BP or Exxon might buy BP. And Shell went out and bought BG Group. And then there was a headline again this morning that said, it's got once more people talking about Exxon and whether Exxon would be interested in BP. BP is still a big bite to swallow, but I think in the long run, probably, a merger or selling themselves makes a lot of sense because of how badly their brand is damaged.
Yeah, I don't know if you know Dan Steffens out of Houston. He's worked in the oil industry for 35 years. He has the energy newsletter, the Energy Prospectus Group. I get his newsletter, and I'm friends with him. I've interviewed him, too. But his contacts in Houston were telling me that Whiting Petroleum, their board, is actively looking. They're pretty desperate, actually, to sell the company right now because of, the emergency capital raise and how much debt they took on to buy Kodiak. They kind of bought at the top of the market. And, those hedges are coming off that they had. So they're pretty worried that I think they're just worried to make sure that they keep any of their equity at all. So I'm surprised that we haven't seen more mergers and acquisitions yet, but maybe companies are holding out for better values.
Yeah, I mean, I saw a story about that, and it said, the ones, unless they're really desperate, the ones who are in a little bit of financial trouble, they don't want to sell at the bottom either, and they feel like this is the bottom, and they'd like to hold out until they could get a better price. And, the big companies like ExxonMobil, they can afford to be patient and pick off, only the most undervalued companies that are in a little bit more desperate shape. And Whiting, so far, they did put themselves out there, and they didn't get any takers, or at least none at the price they wanted. So, I think maybe it's not cheap enough yet for an ExxonMobil for a Whiting, but maybe they're certainly those discussions are going on within ExxonMobil is, who is out there, who looks cheap, and who might we acquire.
Yeah, ExxonMobil is kind of licking its wounds because they were heavily criticized. I think they bought XTO, right? They bought them towards the top of the natural gas market. Yeah,
they did. Same with ConocoPhillips and Burlington Resources. I was working for ConocoPhillips when we made that deal, and that was at a very high valuation.
Yeah, if they would have been a little more patient instead of jumping on there, they could have had it a couple years later at an immense bargain compared to what they did. So, there's just so much pressure, though. You've worked at large companies. I just interviewed Keith Neumeyer, CEO of First Majestic Silver. He's one of the largest primary silver miners in the world now. And he was basically telling me how the investment banks are calling him up every day, trying to get him to sell more shares for equity or take on more debt or to do leverage buyouts and acquisitions and things like that. So there's just an enormous amount of pressure in the executive suite to do something instead of just wait and be patient and, buy the assets at a good valuation.
Right.
My next question is about T. Boone Pickens. I think he's saying that oil is going to go to $70 a barrel by the end of 2016, or is it the end of this year? And then he thinks $100 a barrel in the next 2 years. Do you think that's pretty reasonable?
I don't know if we'll hit. I think definitely we'll be back to $70 by the end of next year, if not this year. It may take a little bit, By the end of next year, we will see the impacts of the capital spending cuts in the shale oil, and we will have had time for demand to grow a little bit more. So I think we could easily be back above 70. I think it's going to take a little bit longer for 100. I think there's enough shut-in capacity right now that as the price starts to rise, you're going to have production come back online. So I don't think we're going to see 100 until we work through, a bit of a excess supply cushion.
Now, at these oil prices, the Saudis claim that they can produce at $9 or $10 a barrel, but they would have a lot more in their surpluses, in their trade reserves, if that were the case. Do you think we're going to start to see governments destabilize at these oil prices? Are we going to see the Venezuelas, the Irans, the Iraqs? Are we going to see maybe a government actually default on its debt and maybe shut off oil production soon if the oil price doesn't start to go back up?
It's very possible, but I think what's going to happen is that at the next OPEC meeting, Saudi is going to blink and they're going to say, okay, we didn't expect this level of pain. And they've actually made some noise in recent days that, they're ready to come to the table if some other producers will be cooperative and they're willing to make some moves to get the price of oil back up. And so I think we're going to see that. They have to be under tremendous pressure from the rest of OPEC. And in fact, even within Saudi themselves, they can sit there and they can say, look, we unilaterally can fix the price of oil. I mean, they've got enough production that, should they take half their production offline, they could put oil prices back at $100 within a week. And so within Saudi, there has to be those discussions going on. Look, we need to maintain solidarity with an OPEC, and we need to get everybody to cut back a little bit, and it'll be better for all of us in the long run. I think that's what they're going to do. Because I think when they decided not to cut production, the oil price was still about $70 or so. And when they made that decision not to cut, that's when we went into free fall and dropped into the 40s. And I don't think they expected that. In fact, I saw one Saudi official interviewed, and he said we didn't expect that. So it hurt them, too. It hurt all of OPEC. It hurt every oil exporting country.
Yeah, but the Saudis are the lowest cost producers, or they're considered the lowest cost producers in the world. So the cut did hurt them, but it hurt them less compared to a lot of the other oil producers. But you think, though, that what I've heard, though, in terms of speculation is that the U.S. may have asked the Saudis to not cut the oil price and let it drop to hurt Russia because there was some pressure on Iran to get a certain type of negotiation done with Iran, and that didn't happen. And then Russia was supporting the Syria and the Assad regime. And then I've also heard other people say that the Chinese, the Russians, and the Saudis teamed up together because they wanted to put the shale oil companies, the U.S. ones, out of business. They wanted to do what the U.S. did to the Soviet Union, in the 80s and 90s, where the oil price collapsed. I think it went from 30 down to 10. So do you think there was definitely a lot of behind-the-scenes geopolitical tension involved in the oil price that was not relevant to the supply and demand fundamentals?
Yeah, I think a lot of that was, just consequence. And, it hurt Russia, it hurt Iran a little bit, but that wasn't the reason they decided not to make a move. Historically, they've been kind of slow to increase supply and to decrease supply in response to oil prices. And I think they said, we'll just sit tight and we'll let the market work itself out. And I don't think they did it to try to hurt anyone or I don't think there was any conspiracies there. I think it's just the consequence. What some of those things did happen as a result. I just don't think they set out thinking, okay, let's let the price fall so we can punish Russia. I just don't think that happened.
Yeah, I mean, I've heard arguments on both sides. So it's tough to know what the truth is. We may never actually hear the truth. Maybe a decade or two from now, someone will put a book out citing sources that they talked about, but who knows how accurate that's going to be. I actually just read a book about a retired KGB agent, and he published his memoir. So who knows? And he released a whole bunch of stuff in there, but who knows if all that's true. So my last question for you has to deal with the ways to invest in the oil market right now. I think we're close to a bottom. Maybe we go a little bit lower, we retest something. But those hedges are coming off. There's $26 billion in oil hedges. I just read that in a recent article I actually put in our oil group over on Facebook that you and I are both in, that I made. And over $100 billion in shale, U.S. shale junk bond debt. So, I don't think all these companies are going to go bankrupt, but there's going to be bankruptcies if we don't go higher. Do you think these are good investments right now, or where in the oil market do you think is a more safe investment?
It really depends on your risk tolerance. If you're a pretty aggressive investor, some of the smaller companies that don't have a lot of debt, they will skyrocket as soon as things turn around here. Some of the fracking sand producers that have had such sharp sell-offs, they will turn around as oil prices recover. But you may have to sit tight, and in the meantime, you may see down spikes of still 20 or 30% from here. So that's if you're a very aggressive investor. If you're a more conservative investor, then I'd be looking at some of the midstream master limited partnerships. Those I think are pretty good, pretty safe investments right now. A lot of those are very close to a bottom and are near their 52-week lows, and so that's where I would be if I'm looking for income, or if I'm conservative investor and want to get my feet wet. If I want to get back into some of the oil companies, I'd go with some of the bigger oil companies. ConocoPhillips, my former employer, they suffered for years after making that ill-timed Burlington acquisition. But they've been one of the best in recent years, and they're near the top of my list. EOG Resources, Devon, all up there, pretty high on my list, and those all held up very well during the correction of the last year. All of them, over last 12 months, all of them are down less than 10%. So I'd be looking at those. I think those are safe places to be. The safest, I think, are the midstream MLPs, but the big integrated oil companies or the pure oil companies like ConocoPhillips and EOG Resources are not bad places to be.
Yeah, I completely agree about the risk tolerance. That's what I tell people. I thought that the oil price was going to bottom at 65.70 because it had, on the chart, oil had very strong support on the chart. It had bounced off $65, $70 support levels for a number of different times over the last 3 years when it had corrected that low, and it always bounced off strong. And, that's why I thought that companies like Seadrill and stuff like that were going to be pretty good, because deep water was still going to be fairly economic at those prices. But then when the oil price dropped way below, obviously companies like Seadrill, I made a mistake on that. I was way too early on companies like Seadrill. But eventually, in order to grow oil production, the shale oil is not a panacea. I mean, the depletion rates are just so much, and we're not having success globally producing the shale at the rates we are in the U.S., and especially at those costs. The U.S. just has an enormous infrastructure advantage, right? Where it has all these, it has all the frac sand, it has all the trucks, and it has electricity and water right around the wells, especially, in the Eagle Ford, which is right near infrastructure. So it just has a cost advantage that the rest of the world, for their shale, they're not going to have. Especially, I think there's water problems at most of the other shale deposits globally.
Right.
Yeah, so I really don't see a scenario where 2, 3, 5, 8 years out, when we're growing production and I see more and more cars coming on from China, I don't see China stopping its demand for people to drive there, especially China and India and Asia. And, the only way we're going to be able to replace these reserves that we're using, we're eventually going to have to go to either natural gas. We're going to have to use a lot more natural gas because all that cheap, easy oil is gone, or we're going to have to start going back to deep water and other not, unconventional forms of oil again at some point.
Right. Exactly.
Yeah, so I think, Seadrill, a company like that, they were extremely well run. They were paying a big dividend for a while, but at this stage, I don't think they're making. They might be making okay money, but they cut the dividend. We've just had dividend cuts across the board. I guess that's prudent though in the oil industry right now is to pay off debt and cut dividends and maybe do some acquisitions with your capital instead of necessarily, especially if you're a producer, not an MLP. If you're focusing on growing your reserve base and finding lower cost production.
Yeah, I mean, well, that and back to ConocoPhillips, that's another thing. They said, protecting that dividend is at the top of their priority list. So, they yield 4.4% right now, and they said they're going to do everything they can not to cut that dividend. That's a move that they don't want to make. Your situation with Seadrill, I made a similar miscalculation on Oasis, which is a small Bakken producer. By the time oil fell to $70, I thought Oasis had well overcorrected to the downside, and at that price they had. But then by the time we got to 50, I wasn't sure they could survive. So Oasis looked overvalued to me when oil was at $100. By the time it got to 70, it looked like a pretty good value. But by the time it got to 50, I was concerned that they couldn't survive. And they did an emergency capital raise as well. And, they may very well pull it out, but they're going to need oil prices to be higher than they are now. I'd like it at $70 if the price doesn't, double going from here to 70, and it could. I mean, as soon as oil prices look like they're going to recover, people are going to pile into those small oil companies and frac producers and so forth, which is why it's smart to, I think, accumulate those when they're out of favor. But you just have to be prepared for the downside.
Yeah, and those are more speculative plays. I mean, with my safer money, I like, Lin Energy and Memorial Production Partners and, those pipeline MLPs. Those are safer money. I mean, higher risk stuff is Seadrill and things like that. Seadrill just has an enormous amount of assets. They have, like, the newest rigs at the higher lease rates, although lease rates have come down. But eventually, the only way we're going to be able to grow production, you and me have looked a lot at the oil market and discussed this in past interviews. I just don't see, like I said, any way the globe is going to be able to consistently maybe grow oil production. We've struggled to grow oil production globally outside of the United States and shale oil production and a little bit in Canada is with deep water. I don't see, or ultra deep water, I really don't see any other way right now unless we stop actually consuming oil and maybe switch to some other form. Maybe Elon Musk is gonna crack everything up here with the super capacitors in his car, the charging stations and things like that, and we're all going to be driving electric cars in 5 years or 10 years.
Yeah, I think 20 years from now the world will still run on oil.
Well, I think the environmentalists would disagree with you, but I agree with you. I think we're going to be running on oil and natural gas for sure, at least for a while. I don't see it transitioning here, even if Elon Musk is successful with the electric car and better hybrids and things like that. It's going to take over a decade for everyone to switch out their cars. It's going to take probably many decades for everyone to switch.
Yeah.
Okay, great. Well, I really appreciate your time, Robert. This was a great discussion, and you gave our listeners a lot of interesting ideas. And we're also starting to see China bail out Petrobras because Petrobras is being pilfered, I guess, by their politicians.
Exactly. Yeah.
Well, and then we have the huge capex cuts here too. So I mean, long term, I think this is healthy for the market. The oil companies are going to be forced to get leaner and meaner. And I guess like that Citibank analyst and the other Wall Street guys are expecting, they'll hedge and it's fine and things like that. But that's not the way these markets work. There's just too much debt out there. I don't think the oil companies are going to be able to last as long with how much debt they have.
Right.
Especially with those dividends that you mentioned there. I mean, they've borrowed like ExxonMobil, Chevron. I don't know ConocoPhillips numbers offhand, but the payout ratio for Chevron, I mean, they've borrowed pretty extensively to keep paying the dividend. So, there's either going to be dividend cuts in the near future, or the prices are going to have to start going back up.
Yeah, I agree.
Okay, great. Well, please tell our listeners about Energy Trends Insider and your newsletters where they can find your articles, because I know our listeners really love your articles and your interviews that you do here.
Yeah, probably the quickest way to find me is just to Google my name, and I think the first or second hit will be my home where I usually write articles, Energy Trends Insider. I write a column there every week or so, and then at Investing Daily, I write an energy column once a week. I write an MLP column once a week, and then I've got a subscription newsletter where I'm the chief investment strategist for the Energy Strategist, and I also write on the subscription letter MLP Profits, which consists of MLP, Master Limited Partnership portfolios that are run, and we give advice on what to buy and when to buy it and when to sell it. And we have outperformed the indices in pretty much every quarter since I came on board.
Yes, you have. I followed your work for a long time, and no one gets the oil market perfectly. I think there was. I'm not even sure there was any analysts other than maybe you or a few others who even saw that there was going to be oil correction. I think most of the investment banks, Goldman Sachs and Citibank now are extremely bearish on the oil price. They're just extrapolating the trend, and they're looking for fundamental reasons to justify they're extrapolating the trend down. But I don't think any of these guys really saw. Especially Goldman Sachs and many of these other investment banks, none of the Wall Street analysts saw the oil price falling in 2014. I think they all had higher oil price targets, right?
Well, and that's exactly what I said to Philip Berlager, who said, he said nobody got the price correction correct, and he was alluding to the fact that him and some other people were correct. And I looked, and they were calling for a crash well into the crash. I mean, we were at $70 and falling when they were calling for a crash. And so I said, you show me somebody who predicted a price collapse prior to June 2014, and I'll be impressed. Otherwise, people are just piling on the bandwagon as oil prices are falling. You want to make a gutsy call, you call for a collapse, when oil prices were sitting there at $100 and looking pretty. And I don't know anybody who did either. I didn't think they could stay at 100, and I predicted, one of my predictions for 2014 was oil prices will have to fall because growing production in the shale oil fields and the fact that we have an oil export ban, oil prices have got to fall. And in the mid-year, that looked like the one prediction of mine that was going to be wrong because oil prices had actually risen from January to June. And I did a mid-year look at my predictions, and I said, 4 out of 5 are looking, like they're going to be correct. But the oil price is, we're going to have a collapse in order for that one to be correct. And we got a collapse. And so I ended up 5 of 5 for my predictions for last year.
Yeah, the Wall Street guys, Robert, like I've dealt with these guys too. A lot of them, are flip-floppers, so they don't like talking about their past track records, like Jim Cramer and some of these other, I don't want to single him out too much, but some of these other, Wall Street guys who are touted with such great admiration, like Gartman and stuff, they just have, if you go back and look, 5 years at all their different videos, their predictions, the wrong ones are way more than the right ones. But they don't want to talk about that. They just want to talk about the last week or the last month because that's their myopic time frame. But there was a lot of deflationist people, macroeconomic people saying, oh, the oil price, they've been calling it every year for the last 5 years or 10 years that the oil price was going to crash. But, they've been saying it every year for the last 5 years or 10 years that it was going to crash.
Right.
So if you believe them, then you're wrong for many, many years. So I think Porter Stansberry, he basically got it right. He was a newsletter writer. He was maybe a year or so early, maybe 2 years early, but he said it was going to crash. But I think there's a lot of bargains right now. It's a very contrarian play in oil, but there's definitely good dividends and cash flow there if you do your homework. Some people though, it just depends on people's risk tolerances.
Yep. Agreed.
Okay, great. Well, I really enjoyed this discussion, and our listeners really enjoy your insights in the oil market. So we'll definitely have you on every couple of months because our listeners request having you back on.
All right, sounds great, Jason. Thanks for having me on again.
Okay, take care, Robert.
All right, bye-bye.